Welcome back to boot camp, and now we are at boot camp number 7. We just got a few to go. Now, I'm telling you right now that I'm going to hold off on doing the last ones because I want Chris and Daryl to be a part of those last pieces, and we can't get the three of us together until sometime in late April, second half of April. So we're going to finish up here today, and then we're going to do something very interesting. I'll tell you about it here at the end about what we're going to do next. I think you're going to like it. But today we're going to walk through what I believe is one of the biggest decisions that a person makes in their lifetime. And it's not just a financial decision, although that's part of it. It is also a decision about lifestyle and what you want your life to be for that, let's call it last third of our life. And I worked probably an extra 10 years to get where I wanted to be, where I felt comfortable about retiring. As a matter of fact, the whole idea was to have enough that I would never have to work for money again, which I have not since 2012. And so it's a big one. And this is this decision between a fixed distribution and the flexible or variable distribution. So I'm going to just take a second here and get the PowerPoint ready to go, and I'll be right with you. So there's the title: Flexible Distributions, the Greatest Financial Luxury for Retirees. And you're going to see why I think that is so. But before we do, I want to remind us that the mission, the thing that we're attempting to do with young people and older people, is to help those people who want to do this all themselves do it better. I know there are hundreds of places you could go to learn little parts of this process. And what we want to focus in on is the investing part itself and how to build the portfolio and how to use it during accumulation and how to do it here today during distribution. But that it isn't my attempt to become your personal investment advisor. I am, like so many people, attempting to teach the things that are likely in your best interest. And so I don't know about your risk tolerance. I don't know all the things that a professional advisor would need to know about you in order to be considered their investment advisor. That's not what we are, and I think you've heard that enough times now. And for people, this is the first part of boot camp that you've come upon. Let me ever so quickly just tell you that, or ask you, or encourage you to go back and watch 1, 2, 3, 4, 5, 6, because what you'll get in there are the first one is devoted to that big decision, stocks versus bonds. The second one is devoted to what the academics believe are the equity asset classes that are the best to have in a diversified portfolio. And then we move on to number 3, where we actually show you some of the best combinations of these equity asset classes that we have found, and not only, in essence, show you those portfolios, but to show you over 50 years worth of performance so that you get an idea of how those things, those equity asset classes, either on their own or in combination with others, how have they done and at what risk? And then we move on into boot camp number 4, where we talk about fine tuning your asset allocation. This is the point at which, having decided, okay, here are the equity asset classes I want in my portfolio, how much should I have in bonds? And so we go through the process of combining all of those portfolios that we had just talked about in boot camp number 3, but we combine them with multiple combinations of fixed income from no equities to 10 and 20 and 30 and 40, et cetera, all the way up to 100% equities. So that not only do you see what happens by adding bonds in terms of return, but you also get a chance to see the impact on risk. And then we said, okay, let's take this, all of these returns we have going back to 1970 from these different portfolios, and let's take the steps to contribute money to build enough to retire. That's the sole purpose of the fixed contributions. What does it look like to build a portfolio from nothing? It is an entirely different state of mind and financial situation when you're just starting because you have nothing. How do you know how you are progressing? How do we judge that year, 1 year at a time? And where should you be after 10 years or 15 or 20 and finally 30, 40, and 50 if you want to go out that far? So we talk about the implications and the things that we need to really be aware of when we're building the portfolio. Then we get into distributions. And last week we talked about fixed distributions. And let me just take a second here to talk about fixed distributions so that you'll know how it's going to be different from today. And that is this. In the case of the person who uses fixed distributions plus inflation, that's important, plus inflation, because let's say that you do have $1 million saved for retirement. That's not more than enough, but it's enough to support what the industry would say is a 4% a year distribution, that is relatively low risk, and that if you had $1 million and you took out $40,000 and you had a portfolio that was some combination of fixed income and equities, maybe 40, 50, 60% equities and the balance in fixed income, how would that have worked in supporting not just the 40,000, but the annual inflation rates that come along at least over the last 56 years? And of course, there were times when inflation was terrible, and there was time when inflation was barely noticeable. So we don't know what that future is going to be. So we want to show you in many different markets how that works for the retiree who retires with enough, not more than enough, because today's presentation is about more than enough. But we looked, as we will look at today, looking at the implications of a 3, 4, and 5% distribution last week plus inflation. This week, we're going to ignore the inflation because as we look at the S&P 500 and the worldwide 4-fund portfolios as examples, in our case, what we do know is that we have saved more than enough. And I want to talk about one more topic because I haven't, in these first 6 boot camp pieces, I've not talked about this in this way, and that is the importance of defense. I am a firm believer that successful investing, once you've decided you're going to take the risk of the stock market, is almost all about defense. Because to make the decision, yes, I'm going to expose myself to the risk of losing everything by going into the stock market. That is, of course, a possibility if you decide that you're going to pick stocks over bonds. But the defensive thing to do is to diversify and have many stocks instead of one or two or three. And then you can buy individual stocks. You could buy 10 or 20 or even 100 different individual stocks and be diversified and be responsible for picking those stocks. Or you can put your money into mutual funds where they actually manage that for you. And what they're managing is the diversification, the selection of the stocks and the diversification. Defense. Then, after you have your money, some in large companies, some in small, some in value, some in growth, some in US, some in international, many different equity asset classes are there. You can put everything in one equity asset class, but everybody says that you should diversify across many. Now, when I say everybody, that isn't exactly true because there are lots of people who put all their money into the S&P 500 large cap blend. But all of the people, I'm going to call them the academics, uh, make the case that diversification amongst many equity asset classes is a strong, important step to take to defend against the catastrophic. And then we have the decision whether to go in no load mutual funds or load funds. Well, there we're managing the risk of expenses because in a load fund, typically stock fund that's got a load, a commission, it's almost 6% right off the top. Never to grow again for you, but to grow for somebody else. So that is a defensive step. Picking mutual funds with low expenses to operate the fund, a defensive step. Picking index funds over actively managed funds, it gives you lower expenses. It gives you lower taxes. It gets rid of bad timing and bad stock selection. So index funds are a huge defensive step. And then to get into the market with dollar cost averaging, where we go in with $100 a month or $1,000 a month, however you go in, you do it on an automatic way that makes you buy more shares when the market is down and fewer shares when the market is up. And the problem for a lot of people is they're happy to buy shares when they're up, but they don't want to buy shares when they're down. This defends you against what we call bad behavior and making the decision to be a buy and hold investor, not use market timing. That again, for people who try to do it on their own, leads typically to lower returns. And then when we start taking money out, if we take out 3% or 5%, well, you know what's going to happen is if you take out five, you're going to be reducing the value of the portfolio at a faster rate than if you take out three. So there is a defensive step you can take. And you'll see today that the difference between 3 and 4 and 5 can be huge. And then when we look at, particularly at retirement, the decision to be a balanced for total portfolio, some in stocks, some in bonds, versus being all in equities can make you the richest person in your neighborhood. I do believe that, and particularly if you started young and you just dollar cost average and you kept equities forever, yes, you're likely to have the most money at the end of a lot of years, but you are facing the risk of what we call sequence of returns risk, where you retire and the first thing that happens to your portfolio is it goes down 50% or more. Remembering the ever popular technology stocks of the late 90s, they went down from 2000 to 2002 about 80%. I mean, it was a bloodbath for people who were counting on those hot technology companies to take care of them in their retirement. And then we have this final decision that I'm here to talk about today. The decision: do I retire with enough or more than enough? I waited for at least 10 years after I could have been retired and had enough, maybe even more than enough, but I wanted more than more than enough. And so I kept working and saving for retirement so that when we retired, and I was 70 at the time and now 82, but I knew that I would be able to take more money out of my investments in retirement, and that if my wife and I were willing to take a modicum of risk, that we would have a chance in our final years not only to reward ourselves, but also to reward those that survive us, our charities, our children, etc. So when you have more than enough, you'll notice what my outline says here. Everything that might go wrong. That's the advantage of having more than enough. I don't care what you could put on the list of bad things that could happen. If you have more than enough, you have a much better possibility or probability of staying the course for the rest of your life. All right. Flexible or variable, we call it both, distributions. And the question is what we're going to look at today. What are the assumptions? Well, as I said, it's for people who have saved more than enough. Now, we're going to show the same $1 million that we did in the previous fixed distribution. But as we discuss it, as we look at it, as we see what it pays out, we're going to make the assumption that we actually retired with 2 million instead of 1. We still have a desire to take out a need. We really need that $40,000. But now we're going to take that $40,000 out of 2 million. And what are the implications of that? And you'll certainly see that in the presentation. Now, we take out the money the first week of the year. That's what my wife and I do. You can do it monthly, you can do it quarterly, you can do it when you need it, however you want to do it. But for the purpose of this study, and we have done this, we did this as well in the fixed distribution, we do it because we don't want to be using money that's going up and down to be there for the money that we're going to live on during the year. And when I was an advisor, we did that with lots of people who liked the idea of knowing that that year's income was right there and it was available in either short-term bonds or money market funds. Now, in many cases, clients had 2, even 3 years in cash. Guess what? Virtually every one of them that had the 1, 2, or 3 years extra money sitting around in order to make sure that there was cash for the next period of time, however long you wanted it to be, they were virtually all people who had saved more than enough. And again, it's the comfort the things you can do that are more comforting once you have more than you need. And then we're going to take out 3, 4, and 5%, but no inflation adjustment. Because if you've got $2 million and you're taking out $40,000, or if you're even taking out twice that, the bottom line is you don't have to worry about inflation. Now, I can't say that forever. And we know what happened in Germany back during the period of time that, I mean, the old story about having to take a wheelbarrow full of money to get a loaf of bread. I mean, it was amazing, the stories about inflation. And if you don't know those stories, you like to scare yourself, you can read about those things and what happens under hyperinflation. And the distribution that we make, this 3, 4, or 5%, is going to be based on what the end of year, the previous year was. So if the first year, the value of you've got $1 million and you're going to take out 4%, then you would take out that $40,000 immediately. Now, by the way, if you have $2 million, it means you could take out $80,000 and be just fine. But you don't need 80,000. It's that's what you want to take out. It's not a matter of an absolute need in order to survive. And we're going to take a look at using both the S&P 500 portfolio as the equity exposure, and we're also going to use the worldwide four-fund portfolio, virtually going to look the same as the U.S. four-fund strategy, and virtually the same, very, very close as the 10-fund strategy, what we called many years ago the ultimate buy and hold portfolio. Now, this table is a little different, and this table, not so unlike the earlier tables we looked at, have very small numbers. They aren't your problem right now. Don't try to read the little numbers. I just want you to see kind of the overview. At the top, we have here how much we're going to take out, 3% a year. We call that a very conservative distribution rate. We're going to start with $1 million. We're going to use the S&P 500 as equity, and we're going to take out the amount we do take out at the beginning of the year. We're going to take it out, as I say, at the beginning of the year, not during the year. And all of these results are right from our fine-tuning tables. So not only are the fine-tuning tables going back to 1970, they're reflected in the accumulation tables, in the fixed distribution tables, and now in the variable, flexible distribution tables. And as you might remember, when we talked about the fixed distribution, every portfolio took out exactly the same at the first of each year, the original 30 or the original 40 or the original 50,000 plus whatever inflation was. Didn't matter whether you were 100% in equities, 50, 50, 60, 40, 40, 60, everybody took out the same amount of money. But now we're in a different world, because what happens during each year is going to have an impact on how much we took out or will take out. So, for example, with the 50-50 strategy, in the first year, you took out 30,000, and at the end of that year, it was worth $1,066,797. So now you're going to take out 3% of that number. And that's the $32,004. So it is once a year of whatever that value was as of 12/31, the previous year. So as we did before, and I know I get tired of talking about these tables. I'm sure you get tired of listening about these tables, but they still represent lessons that apply to a certain group of people. And even though they may not apply to most of us, for the people they apply to, we do want them to see more rather than less information. So, as we did in the previous presentation, we're going to look at the periods 1970 to 79, 1980 to 89, and 1990 to 99. Now, there's nothing magic about those 3 decades. And for those people who want to test, for example, from 1980 through 2009, you could actually do all this same information, create it starting from scratch through the Merriman lifetime investment calculator, where we have all this data there, and you can go in and test it for different periods of time. You can test it for not just 3, 4, and 5. You can take out 4.5 or 4.6 or 4.7. You have control of your financial future in terms of being able to test the past with that calculator. Anyway, what do I see here that's important? Well, what I see is that by taking out 3% or starting with 30,000, with the flexible distribution, you ended, and I'm going to look at it kind of by the decade. At the end of the 10 years, you are now taking out 41,000 under the 40% equity, 60% fixed income. With the 50/50, you're now taking out 40,295. With the 60/40, you're taking out 39,110. And if you had all of your money in equity, you're taking out 33,951. Now, why is it as you add more equities to the portfolio that you have less and you take out less? And the reason is because it made less. It was not a great period for the stock market. Bonds actually paid fairly good returns during that 10-year period. So, what it tells us is that well, in fact, we could even look at the low point because we are concerned about having to take out less. Oh, wait a minute, I forgot something. I forgot to multiply the 30,000 times 2 because you're actually taking out 60,000 because you saved more than you needed. And so as you go through this period where inflation becomes a bit of a problem and the equities aren't quite what you had hoped, you would see that you still had plenty of money. You didn't have to adjust for inflation because you were taking it out based on more than enough. But I don't think it hurts for us to look at just what happens without the doubling to see how you would have done if you're thinking that you might be willing to cut back your lifestyle in order to do this, even if it didn't give you enough. Maybe you'd be willing to go work part-time and make up the whatever that deficit is. But let's look at it that way as well. So now as we go forward to 1980 through 1989, notice now all of a sudden you go from low 40s from at the end of the last decade to almost 3 times as much. 113,000 was the payout in 1989 with a 40/60. If you were in 50 and 50, it was virtually the same, 114,000 plus. If you were in the 60/40, again, very similar, $115,000 plus. And the 100% equity had to come crawling out from that low point. It got behind because the equities performed poorly during that previous decade. So by the end of 2 decades now, all of these things are about the same. Here in the case of 100% equity with the S&P 500, 113,000. So the people who decided to be 60/40 or 50/50 or 40/60, they're feeling pretty smug because they've got as much money, maybe even a little bit more than the S&P 500, and the S&P 500 people took a lot more risk. let us not forget, buried in there is 73, 74, where at one point the S&P 500 was down more than 50%. Now we go to the next decade. We're still taking out the 3%, and percentage wise of whatever the value is of the portfolio at the previous year. Notice by the end of 1999, we're taking out $278,000. Remember, we started with 30. And if we just pretended we were doubling this, we're talking about over $500,000. Now, with 9.8 left over for the family, if that's when you end your life. Or if you had more equity now equity's been performing well, and that additional equity has you up to 11 million and even more at 60% equity. So the choice between 40, 50, and 60, every time it's about, well, $1 million, let's just say, is the payoff for taking 10% more equity in your portfolio. And the 100% S&P 500 not only pays out 481, but the heirs get $18.8 million at the end of the 30 years, if that's the end of your life. So these decisions, whether we use fixed or we do variable, in fact, let's look right here. We can see the last year's payout in 1999 with the fixed distribution. The last year's payout was $130,000. And if that was the end of your life, it's got 16.5 left over. Okay? If we look at the last year with an all equity portfolio here, instead of 16 million, you've got almost 19 million. But the last year's payout was $482,000 times two, if you want to look at it that way. You had a payout theoretically of almost a million versus the 180. And this is important to understand why this happened. One is when inflation kept marching along, you could thumb your nose at it and say, I don't care about that. I got more than I need. I don't have to adjust because of inflation. You did, though, certainly adjust in terms of distributions. And one of the reasons the distributions got so big was because early on you weren't forcing the accounts to take money out when they really couldn't afford it, if we want to call it that. And so you were willing to take less when the market went down. And what happened was, in taking less, it meant that you had the opportunity to be at a higher level when the market did turn around. And so as you catapulted up to new level highs, it was much faster where you hadn't drained the pool. So by being able to overfund the pool and then not have to take unnecessary extra money, the extra money comes in the long term if the market does well. So that's at 3%. And when we take out 4%, it means that you're going to be draining the kitty at a faster rate. And so as we look at the year-end balance, very similar year-end balance down here, a little less than we had with the 3%. And when we get out to 20 years, we have less than we had with the 3%. And of course, we're taking more money out too. Why are we taking more money out? Because you started at a higher number. So every time inflation hits the fixed distributions, you're going to have to pay a price. Well, in this case, you don't have it getting hit at all. So that has no impact here. I'm I'm sorry if I suggested that, but let's just take it one more decade. And here's what we have now. Instead of 10, 11, 12 million, now we're down around 7, 8, and 9. And over here, 13 instead of, I think, 18 or some such number, was it? Or maybe it was 14, excuse me. Anyway, the bottom line is that because you took out four instead of three, you had less money left at the end, and you're still taking out tons of money, by the way. Here we can look at the 4% and compare it to the distributions at 4%. Over here, 173,000 was the final payout for the fixed distribution at 4% starting and adjusting for inflation versus over here for the 40/60 it's 274, 305 for the 50/50, 338 for the 60/40, and 475. So you're taking out a lot more money, tons more money with the variable. And that's because you have the ability to let the portfolio grow and not be punished by those higher distributions. And yet the distributions that you were getting over this 30-year period were almost, well, they were more than enough because you started out with more than enough. Now, here's where the magic happens. Because before, when we took out 5% a year with the fixed distribution, it punished the portfolio. It got down very low in the mid 70s. But here it was hard on the portfolio. You're getting down now. Remember, we were at about first we were at the end of the first 10 years, we were at about 1,400,000, and then it was down to about a 1,300,000, and now it's down to 1,200,000, 1,200,000, almost 1,200,000. For the all equity, 1,000,000, a little over 1,000,000. So you got hit, and you got hit pretty hard. But again, you're not worrying about it because yes, 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 you have more than enough. You started with 2 million, not with 1 million. So you're hanging in there. You wish you had more. It wasn't what you planned on. But the next 2 decades, as we know, give us the chance. Now, by the way, you might remember, I mean, we're really getting low here compared to where we were before. And when we get to the final now, the 30-year period, instead of having 8, 9, 10, 11, 12 million, now you are here and you are down a payout of 253 with a year-end balance of 5 million, a payout of 282 with about 6 million. A payout was 60/40, 60% equity, 40% bonds, about 6.7 million, and the S&P 500 all on its own a little over 10 million. I mean, the kids aren't going to complain, but taking out the 5% instead of the 3 or the 4 does make a big difference. But I think it's interesting now. Now it starts to show why I believe so in the idea of retiring with more than enough. 30 years is a legitimate period of time to spend in retirement. In fact, for the fire movement, 50 years is a normal amount of time to be in retirement. But look at this, with fixed distributions that we were continuing to try to keep up with inflation, and we're into our third decade. Well, we slowly ran out of money. And by the time, if you were 50/50, you ran out of money in 1998. You were totally out of money in almost every case in 1999. Nothing for the kids, nothing for the favorite charity. Now, yes, it's true. Most people won't sit there and do this to themselves. They'll figure out a way to survive. They'll do the reverse mortgage. They'll sell the big place and move into a smaller place. It it isn't just that you're going to go broke. It's just that there's the possibility that you're going to have to make an adjustment that you might not have to if you had had more than enough. Now, when we look at the four fund strategy, the worldwide strategy, we already know that it makes more money than the S&P 500. Over the last 56 years, I think it's about 1.6% a year. And we also know that an extra 0.5% over a relatively long period of time, and 30 years is a long period of time, but an extra 0.5% can mean $1 million. And you be able to see that, I think, here in even in this 30 years. So here's what we look at. We're going to start with the 3% payout using the flexible, using the four fund worldwide. If you don't know these portfolios, it's a portfolio that is a quarter large cap blend. It is a quarter large cap value. It is a quarter small cap blend and a quarter small cap value. And the four funds come from either overseas or in the US so that you have exposure to these four historically huge performing equity asset classes, but also focused on large and small and value and growth, because those four things, large and small and value and growth, they do not go up and down together like you might think they do. They do sometimes, but most of the time they do not. And that's the beauty of putting them together and making it a diversified portfolio. So we're going to do the four fund strategy, and we're going to look and see at the end of the first decade. Now, instead of being 1 million to 1,000,004, you're almost at 2 million with the 40% in equity. With 50% in equity, you're over 2 million. With 60% of equity, you're over 2 million. And with the all equity, you're at 2.6 million. So what happened was, during that period of time, while the S&P 500 struggled, a portfolio that was diversified worldwide with the small, with the value, along with the US and the large and the growth and all of them part of the portfolio. But the other parts of the portfolio perform much better than the S&P 500. So what you are seeing here is that impact of having those other equity asset classes. And when we go out to the 20-year on the 3% distribution level, now we're up to about 7 million, 8 million, 9 million on the 40, 50, and 60% equity. And for the all equity, we are up to about 15 million. By the way, with the S&P 500 index, that was worth under 5 million. So at the end of 20 years, you are way ahead. Now, what happens is, in the 90s, the S&P is kind of top of the mountain, if you will. And at the end now, we have for the 40%, 11.6 million, for the 50%, 13.8 million, and for the 60%, 16.3 million, and for the four fund all equity strategy, 3% flexible distributions, first of the year payout. You have almost $30 million. And look at the payouts that you were getting, particularly if you were if you started with 2 million rather than one. And by the way, it would have worked fine as well if you had been 1.5 million, but you wouldn't be able to double these numbers. And but you see, look at the double of what would have been paid out in the 60% equity, 455, and that's about $910,000 or so. That is a huge payout. And of course, one of the things that's wrong with this picture is that, and this is true of both the fixed and the variable, but what's wrong with the picture is the point at which you're getting the big payoff turned out to be when you were really old and probably wouldn't know what to do with that money, but give it away in many cases to children and charity. But I think to the extent that you want to ensure you're not going to have any problem with inflation, you want to ensure that you're not going to have any problems with the unknowns, it is certainly wonderful to have more than you need. And here we can see it compared to the 30,000 with the fixed distributions. We can just here's the worldwide fixed distributions. The value of the 100% equity is almost $45 million with the $30,000 a year distribution with the fixed. And here we're at 29,000. But the amount of money that was taken out in distributions to have fun with, to feel good about, to share with others, whatever it is would probably be more important than ending up with $44 million. But this does give you a chance to see that over the 30-year period, the four fund worldwide fixed distributions, you have left over about over $22 million with 60% in equities. Anyway, these chances to compare, one of the beauties of the tables that Daryl Balls has created, one of the things I love is you can just take them and look at two of them together and compare them. There are, I think, 70 plus tables that we have on distributions between all of the fixed and all of the variable distribution tables. And we know, of course, when we are going to be taking out 4%, we're going to have less left. And at the end of the 20 years, you can see those numbers are much lower. And at the end of the 30 years, you can see at the 4% distribution that you are down to much, much lower numbers than you had before when you started with 3. So that starting amount and your rules have an impact for the long term in terms of what you spend and what you leave. And here you can remember just a few minutes ago, we were talking about multiple over 20 million or 40 million, whatever. By the time you take out the 4% instead of the 3 and leave less money there to grow, it makes a huge difference. In fact, you can also see that going from 40% equities to 50 is $1 million more, to 60 is $1 million more, to 70 is more than $1 million more. So every bit of increasing exposure to risk, taking out less, all of these things are going to move the outcome around. And you're going to be in charge of it. but better to be in charge of something that gives you plenty of wiggle room rather than not. And finally, we look at the 5% distribution. And here again, you remember that we had problem making it. And even here, we don't have a pot of gold here at the end of 10 years, about 1600, 1700, 1800, all equities over 2 million. When you go to the 20 year, at the end of 20, you're up to about 4.5, 5.2 for 50% equity, 6 for 60% equity, almost 10 for 100% equity, far lower than we saw before. But here again, here's that magic. That last 10 years, instead of running out of money. Now, by the way, with the four fund worldwide, if we look at the comparison of the four fund uh, on a fixed distribution, with the exception of a couple of columns that didn't have a lot of uh, a lot of equities, everybody made it to the bottom, made it through the 30-year period, left plenty of money to family, did not run out of money. Whether you were a flexible or a fixed, you did not run out of money. And in both cases, even though you had been taking out at a very aggressive pace, the 5%, you were the children in charity were they were left with enough to, I think, have it be meaningful. So I hope if you're really trying to make a decision about what portfolio and how much do I need to retire and how much more do I want to save than enough, I hope these are helpful. Again, investors who save more than enough, the flexible distributions protect you against losing so much when the market goes down because you automatically take less out. And also the flexible increases distributions as accounts grow because it has protected against the bad times, being able to have more there when the market does turn around and go up is a big benefit. And also, the flexible allows higher distribution percentages. I know now, my wife and I, we could have taken out 6% instead of 5, but I just felt like 5% was enough. And it ends up impacting not our lifestyle, but maybe how much we give at the end of the year. But the end result is by doing it this way, we are going to have more to give at the end of our life. So we have found it to be a great balance, not only of having more than we need and having a portfolio that has big and small and value and growth, U.S. international REITs and emerging markets, and the right amount of fixed income. For us, it's 50%. And we've been living with all of those things, never even thought about changing anything, nothing. Now, do I wish that we didn't have any REITs? Well, you know something? I wish I didn't have any S&P 500 during the 2000 to 2009 market because it was a losing decade for the S&P 500. I always know what I wish I had more of and what I wish I had less of. So you got questions, send them. Send your phone number along with them so I can call you if I need to follow up with a question before I answer your question. Now, let me tell you just briefly about next week. Because we don't have our sidekicks here to work with us right now, I want to wait till they come back, as I said earlier. But I still know that a lot of you are really wanting to know what's up with the best in class ETFs. And we do have a new approach. So next week, I'm going to talk about that new approach. I'm even going to give you a list of the funds that are on the new list, but I'm going to talk about what they mean to you as an investor and what they mean to me as somebody who wants you to have the right answer to manage your portfolio literally for the rest of your life. And I'm not going to be around for the rest of your life. And so we need an answer that survives Daryl and Chris and myself, but an answer that we truly believe, as much as we know anything about the future, will be probably better than what 99% of investors will get. And I mean that 99%. And so next week we'll talk about that. And again, I so appreciate having you there to share this with. I hope that this is going to help you make a better, pardon me, a better decision about taking distributions, how you're going to take them, how much, fixed or variable, what your portfolio is going to be. Those are all major decisions, and let me know where I'm failing you, okay? And tell others about the boot camp. I was on a show with Stacking Benjamins, and Joe was very kind to talk about how highly he thinks of the boot camp series we're working on right now, and trying to get people to go there and go through it. I'd love your feedback on how it's helping you, and and you've probably noticed sometimes I use those as testimonials, but you'll also notice I don't use your names. So if you want to say something that's meaningful, you think would help others make the decision to dig into our work, that's always appreciated. When you go to our YouTube channel, if you haven't subscribed, appreciated. If you don't, give it a like, appreciated. When you donate money to our cause, appreciated. It's all appreciated. And in the newsletter this week, we did announce the upcoming interviews with Larry Swedroe, Bill Bernstein, Christine Benz, and Mike Piper. I am going to have a ball, and I'm going to be there to ask them the questions you want to ask them. I'm sure that many of you know the work of all four of those people. And if there's something you've wanted to have somebody ask Christine Benz or Bill Bernstein or Mike Piper or Larry Swedroe, Paul at paulmerriman.com. Whoops. It's not, oh, there it is right there. Just email me. Email me. Give me the question you want me to ask them. I am really excited to have an opportunity to interview these people. They are so smart, and I know, having known them for many, many years, these are people who really want to help you. So let's let them help you. Help me help you. Thank you. And all the best to you and your family for a better financial future.